Hi, everyone. Good afternoon. Thank you very much for joining us at Hub 71. We're excited to be continuing our weekly Fireside Chat series. We do this every time we have an active accelerator program going on, where the experts that we bring in for the program, we ensure that they're also sharing their knowledge and expertise with our general larger community. So it's fantastic for all of you to be here, and thank you very much to my very esteemed panelists who are going to fill up the whole time, and I'm going to not ask that many questions with their amazing knowledge and experience. So it's a very big topic that we're covering today. They're all expecting to leave with a concrete answer on raising in this current economy. So knowing that we're in this VC space, there's always only a concrete black and white answer. That's what they're expecting to get away with today. So we're going to attempt very much to give you guys as much insight into it. But before we tackle this topic and break it down further, I'm going to hand the microphone over to Shirley and Michael to do two things. One is introduce yourself, but also introduce the company that you're with, because they're both representing VCs and programming in very different spaces. Similar, but different spaces. Okay, so let's start with Shirley.
Okay, so you're saying that my "it depends" answer is not going to work for this panel?
What do you mean? You were prepped.
I was prepped. Okay, no, it depends. I'm Shirley Romig. I'm the Chief Accelerator Investment Officer at Techstars. We are not a traditional VC. We like to say that a lot because we're really quite a weird animal in this space. We run an accelerator. We'll invest between 700 to 800 companies a year. We have a fund business where we invest standard check out of, and then we have corporate programs. We also have non-equity programs like this one at Hub 71. And I oversee the sourcing, selection, accelerator side for both investment business and the non-equity side of the business.
You also had another life where you did other things before Techstars?
My other life, yes. Let's see, what did I do? I started out, I'm kind of old, 25 years ago now, helping traditional companies go e-commerce and go digital in the first wave, I would say, of the dot-com boom and bust. I launched an e-commerce business with Saks. Fast forward, right before I came to Techstars, I did a 0 to 1 startup in the social content creator space. And then in between then, I ran a couple of businesses at Equinox and at Lyft, which is a market business and rideshare in the US.
Amazing. And Michael, hello. Welcome back.
Hi, everyone. I feel like I need like a bed or a room here, so I spend a lot of time with you guys. I'm Michael. I am a partner at Golden Gate Ventures. We are a Singapore-headquartered VC fund. We invest across early stage in Southeast Asia, and as of very recently in MENA as well. We write checks between $500,000 to $5 million. We have about 97 portfolio companies. We're agnostic in terms of industry, but we are typically early stage. In terms of my background, I am also of an older age, but
you don't look it.
I feel it though. But I've been in the tech space for quite a while. I used to be an operator, similar to you guys. I ran a data center out of Europe. Our company got acquired in 2007, and I've dedicated my life to investing ever since. And I'm glad to be here.
Amazing. Michael is in and out of Abu Dhabi because he's hopping around all the GCCs all the time. Okay, so we are going to be talking about raising in the current climate and really talking about the evolution of the VC landscape over pre-pandemic, during the pandemic, that incredible roller coaster, and then what it's like moving forward, what you're both excited about, what you're both terrified about, and what they can potentially expect to see. So before we get started, just very quickly, my name is Lalitha Wemel. I lead the program, as Shirley said, with Hub 71 for their General Funnel Accelerator. So if you want to talk about the program, come and talk to me so I can introduce you to the right people to actually talk about the program. Okay, so let's get started. Maybe Michael, you can start us off with, because you've started in Asia, then you expanded into exploring here a little bit more, both from the VC angle, but also looking at founders in the region. What's the biggest thing that you saw during this roller coaster? Pandemic, post-pandemic?
Yeah, I mean, it's been an insane, I think it's 3-4 years now. I can still remember this was in 2020 when I'm not sure for you guys, but I remember when it was February of 2020 and we had a big group of VCs from the US. They were flying into Abu Dhabi, Dubai actually. And there was this big debate about whether you should travel, yes or no, because kind of COVID was coming. And we had this one of our VC colleagues, and he was talking about wearing masks, and we're like, this guy is nuts, man. What is he talking wearing a mask? Are you serious?
Pandemic who?
Yeah, 1 month later, we were all wearing masks. But what was interesting about that time frame, not sure if you guys recall, but Sequoia had a big publication later in the year, which they called Black Swan events, and where they effectively said, during COVID, just make sure you have enough capital in your bank account, you have enough runway, you make sure that you cut down on costs. And funny enough, I think about 2 months later, venture took off. Like valuation skyrocketed, like the amount of capital going into the market was absolutely insane. But then only for 2 years later to see that message come through. Because what eventually happened was all the VCs were talking about you have to be profitable and you have to cut down on costs and we have to extend our runway. So it's been a very, very difficult and challenging few years for founders to kind of navigate that landscape. But it's been equally difficult for the venture capital market as well, right? And just to give you guys a few examples to sort of understand where the VCs are coming from. So whilst all of this is happening, like our bosses, everyone has a boss, right? So I have two bosses, my LPs and my wife. And my wife is stricter than my LPs, by the way. But our LPs are typically waiting for distribution. So they invest in our funds, we invest our funds into you guys generate amazing returns, and we give the money back to our LPs. What happened in between 2021 and actually to date is that the IPO market has dried up. We haven't seen any large M&As happening. So all of these limited partners are waiting for liquidity from our end. And because it dried up, the investment slowed down. So to give an example, in Asia, between Jan of 2021 and Jan of 2023, the deal count was down 70%. And I think it's fairly similar in this market as well. I'm not sure about the US, but it's fairly similar here. So within that landscape, you are trying to kind of raise funds as a founder. So I think a few things have changed. Every single investor is going to talk about profitability or your path towards it. That means a lot for you as a founder, because a few years ago, we told you, like the same people told you, grow at any cost. Here's more money, don't worry about it, we got you. And then like a year later, we're like, hey man, I'm sorry. You know what I said last year, not entirely true. You have to kind of focus on cutting your burn. So I think for founders, there's a new reality, and for VCs as well. And I think the reality is we have to get back to normality and get back to sanity. And that starts with a few things. We talked about valuation yesterday. So that starts with getting a healthy valuation. A few years ago, we talked about runway for 6 months before people go out raising again. That's 18 months now. So that conversation has entirely changed. And I'll pause here because I can talk for like 6 hours. So I'll stop here.
I was just about to pause you so that we can get to all your amazing points shortly. Yes.
I have so many thoughts on what you said. Oh my
I've been
gosh.
writing notes as you were talking.
Famous last words from a VC, we got you. Black Swan event, so interesting you say that, because in 2008, I think I skipped over this part, it was a dark period of my life. I was in equity research in New York in the financial crisis, where people asked what you did, and you were like, I don't work in finance. And then the world was falling apart, and Lehman was going bankrupt, and Merrill and all that good stuff. And because of that, when COVID came, I actually was like, holy moly, get cash, market's gonna crash, everyone's gonna, no one's getting paid. And then I was really, really surprised by the headiness of the next really up until like Q1 2022, Q2 2022, where things really started to hit the fan. And I think what I didn't appreciate is just the zero interest rate environment that we have taken for granted for so long. It was almost like we didn't think about that, which is really silly because, I mean, I went through 08, 09, I went through 2000, 2001 to 2004. But it's almost like we don't learn the lessons, and then you kind of take the pain all over again. I mean, so many things that you said that I'll echo, but I would say that, if you're in the audience, you're probably a founder and a builder, which I so love and appreciate, because there's one thing that I love nothing more in life, which is to build businesses, and I've been able to do that in big companies and my own startup, and there's nothing more gratifying in the world. And I would say that the current environment where we're in now is actually back to really normal. It feels really abnormal because we're kind of comparing it against 2021, where it was like, you have a deck, you get $6 million, right? And I ultimately think that we're in an environment now where you're going to build just much higher quality businesses, right? So everyone is sort of influenced by their trajectory, and I started my career out in retail and then retail consulting and then e-commerce. And retail is such a tough business where, if you were to launch a business, you have to get to profitability in like 6 months to a year. That's just how you build your models. There was no like kind of this runway or burn and all of this stuff, build it if it'll come. It didn't like the math actually had to work. And that's the discipline now that we tell our founders, and that's the discipline now that you really need in order to raise. And obviously it depends on what you're building. If you're in AI, then you have a lot more leeway. But if you're really kind of in any other business, the metrics are coming at you are going to be very, very different, right? And it's back to the fundamentals, like build a P&L and make sure you actually, it's not even just like you have to show EBITDA, at a very early stage.
I want to come back to this profitability versus growth conversation we're having. But also, just on your note about AI, do you feel like they're actually stuck in the 2021 bubble of where everybody is just, oh my God, AI, oh my God, you have a language model, oh my God, you have a deck, amazing. You didn't change the font, that's fine. Here's $6 million just on an AI panel, which is why.
Yeah. I mean, not yes, but no. I mean, listen, it's not so much pain in the.
It's not a no-no.
It's not a no-no, but it's also not like, oh, you got AI in your title and your pitch deck, here's $6 million. I mean, there's definitely a lot more scrutiny, right? Because the incentive to deploy money is just not where it is before. And I think to Michael's point earlier, like if we think about the whole ecosystem, let's back all the way up. Like LPs are really very leery of the VC asset class right now, like super, super leery. And it's because there hasn't been any exits. And, like the visual I like to use with my founders is like, it's just a like super complicated or constipated market. We don't know when it's going to open up, but it will. We're thinking internally probably like second half of 2026. And so you got to like think about how you last until second half of 2026, which is kind of a far time from now. And maybe second half of 2025, you keep hearing stories like, well, maybe this is the IPO that's going to like break things open. But we don't know, right? And so the point is you got to plan for a really long time. And because there's no IPO market and the multiples in the public market is so depressed, then the VCs are looking at all their portfolio and they're like, I don't really know what this is really worth. And their LPs are like, I don't really know where my money is. and so VCs aren't able to fundraise. So the stat really kind of blew my mind. But in the first quarter of 2024, A16Z, so Andreessen and General Catalyst accounted for 44% of the fundraising. Like two firms. And so there's a true flight to quality, like I don't even know if you can call it flight to quality. There's literally two firms that's raised 44% of all the VC dollars or that allocators are putting out there to the VC asset class. So it's just a, it's, I don't know. I rambled on, totally lost my point, so help me.
It's okay. You can just say the end, and we're going to
I'm
come
gonna
back.
use my jet lag as an excuse. How's that?
Everybody here has jet lag all the time.
Yeah.
I get what you're saying, and we'll come back to that because I do want to have a conversation about if it's difficult for founders to raise, it's equally difficult for VCs to raise in what was a boom and a crash, and now you're kind of stabilizing because so much of, I guess if you came into this space like 5 years ago, this feels like a dip, even though this is a norm, because you would have been at the height of it and you'd have been like, this is where it's at. But I would say so many different VC bubbles around the world, especially what goes on in the Valley, is just a different kind of hype. So how do you advise founders, I guess, to understand that this is actually the stability? And going back to Michael's point earlier, how is it an insane concept that we want founders to be focused on profitability? That's the goal.
Yeah, but I mean, in all honesty, we're all to blame, right? So we've kind of.
I'm not taking the blame away from us.
Yeah. Like all of us, because we kind of built this environment where this was possible, and everyone is retracting as fast as they can. I want to add one point to the previous question on this was specifically around AI, I think. We had a very interesting debate with a founder, and so he's building a very interesting AI type business, and we've asked for their financial model, and luckily they were very prepared, so they shared the model, and we went through it line by line. And the funny thing was that the founder said there's only 3 VCs that actually did this, because a lot of folks kind of skimmed over it and said, oh, fantastic product, looks good, we'll kind of push it in market. Yeah, we trust you, which is fine, but you know, you have to do your job. So you still have to kind of run through what the financials are. So it doesn't matter to me which industry you're in. Like honestly, I don't care. Your fundamentals have to be correct. So if you're in an AI business, awesome, good for you. You know, you have our support. I still want to see your financials. And we're still going to run through it line by line. I went so far, we looked through API calls. And I asked him, what are your margins on your API calls? And this guy was like, dude, just please stop. I said, no, because I want you to understand what this means for your business. And you're assuming 30% gross margin now. Cool, awesome. What are you assuming next year? 40%? Awesome. Why? And those are the fundamental questions that I think our industry should continue to ask founders. And I think then you're in a good place. And then it doesn't really matter. If you want to value a company at 100 million, good for you. If the financials are in order, yeah, go for it. So I just wanted to add this to your point.
No, I completely agree with you. I think we see more founders generally than like the average person does. And you would be surprised as to how many are actually so data-driven that they could tell you, they could spit out your financials like on the go without having to refer to anything because they've done the work, they know the thing, versus the person, there are founders on the flip side of it that just don't, and they just expect to be able to skate by on.
Sorry, I got a lot to say. Sorry,
Side.
I want to add one more thing. I do feel that the time now is that we all got sort of shell shocked, right? And to your point, like for some founders and even for some VCs, this is kind of their first kind of downturn. Seriously, we saw 2008. I built my first company during the dot-com bubble, so you know we've seen those hurtful periods.
I'll take your word for it.
Yeah, it's true. But yeah, for some folks, this is kind of the first proper downturn. What I am noticing, luckily, is that the quality of founders is so much higher. You guys are way better prepared than I was back in my days.
100%.
Or than founders like even 6-7 years ago. So I'm very bullish on investing now, just because of this time. Just wanted to add this.
I would also add that because of the quality of founders being so much better, the bounce back from it has been so much faster. Like getting to this stability where you're saying basically by next year, 2026, 2025, you're going to be back to truly equilibrium normal.
One thing to, this is one of those days.
One more thing.
Because I'm piggybacking on your points, because you were talking about public markets. So one thing I've learned over the years is we ask our portfolio companies to look at their equivalents on the public markets and look at their trading comps. And it's just helpful to understand because for some founders, you're like, yeah, we're going to build a $100 billion business. Cool, but could you look at your peers and maybe see where they are? Just for you to get a sense of where you potentially could be. And of course, you want to grow bigger and faster, et cetera, which I get. But it's helpful to understand what does public markets trade at and get a bit of a sense there as well.
Yeah, your point, that's such a good one. I think that VC partners and accelerators like us can probably do a better job of helping founders just generally understand valuation, right? Lalitha and I were talking about this yesterday. Valuation is just kind of an art at the end of the day, right? Because these are...
Is it an art or a science, Michael?
Well, it's both. It's science sprinkled into ultimately the art comes out. But, we have these discussions internally too. It's like we have a certain way of looking at our... So Techstars, just to give you some context, we have 4,000 companies. So every time we go through a valuation process, we have to look at 4,000 companies in our portfolio, and we're adding 700 to 800 a year. And so we obviously have to triage and kind of think about who are the companies that we're really going to dig into. But we have a certain set of evaluation methodology that we use. We have the same portfolio company that we own. Another investor will have a very different view on valuation for that company. And so there's often debate as to why VCA will value this company in this, but we have another valuation in a company, and we try to be more conservative and rigorous in how we think about things, which, again, the argument is that a good for us? Is that a detriment for us? Because YC will be out there saying, we got X, and we're like, we got X minus, but we're just, again, different philosophy, right? It's around how you think about valuation, but I think this discipline of helping founders understand what their valuation is really important, because I really think we've lost sight of that. Like in 2021, 2020, should a 15 million ARR company really be worth $1.5 billion? And think about what it takes to actually have to grow to that valuation. And I think that people just got to the stage where you were just chasing that big valuation number, and you forget at some point you have to come home to roost, or whatever the saying is, right? And it's like, well, what revenue, what actually, not even revenue, what profitability, what EBITDA, how many dollars in EBITDA do you have to have in order to be worth $1.5 billion? Well, look at the public markets. What are the multiples? If the multiples in your market is at 20, 25, and that's being generous, do the math backwards and say that's actually your profitability. That's not even your revenue. And so I think that this is a really obviously tough environment. We're all hoping for it to get better. But the markets will open up, and we're all counting on that. And then by that point, we're going to have much, much healthier businesses, and that'll be a beautiful day.
How exciting for us. What a goal. Just healthy, beautiful businesses. We spoke yesterday very much about valuation, especially in this region, and how there was an acceptance towards very much a pre-money valuation when they're raising here, and now it's just the norm is going to a post-money valuation, which is somewhat safer for VCs. Do you want to add some thoughts on that before I go on and dive deeper into our profitability versus growth conversation?
Yeah, I would say just on valuation, because there's always this this number that gets stuck in your head, and that's what you're kind of thriving towards. But I always tell founders, just don't worry about your early stage valuation. You're going to be just fine. Your concern really is, do you have enough ownership, and are you building an amazing business? And the rest will literally fall into place. I have just a funny anecdote, and I cannot, it feels like yesterday, I cannot mention their names, but there's
all redacted.
Yeah, there's a company in Asia, and very, very stubborn founder, extremely stubborn. And his investors were trying to shove money into the company, and he kept saying, I don't need it. And the cap table, they were getting fairly annoyed because you can grow fast. He said, yeah, I know, but I'm doing okay, so I don't actually need it. So they sold the business, I think, for about $250 million. Yeah, $250 million it was sold, and the founder owned 60%. Just think about this.
He was stubborn for a reason.
No, but the issue.
But it's true.
Yeah, the issue is like early stage. He didn't care about the valuation. He said, "This is the amount of money I need. This is the amount I'm willing to give up in terms of my equity, and I'm going to build a business." And which he did.
Yeah.
Company got acquired. He is well off. I think he's in a farm somewhere. He's like, I don't care.
That is the actual dream, to retire and be on a farm.
I think he's going to build like another business, but I'm saying this because he made the right decision. And he could have been driven by, I want to build $1 billion company, et cetera, et cetera. No, he had a very, very clear vision on ownership, on value, and focus on building a product.
And I think when you look at valuation not as a badge of honor, but an actual representation of what you're doing in the company and the work that you're doing, it ends up being a story like that, as opposed to you're raising on a ridiculous thing and it ends up just smacking you in the face at the end.
Yeah, there's this, I'll make one more small comment. There's this weird pressure we put on ourselves in our industry. Like a number of times, like you let's say you raise at 20, right? And or let's say at 40. And you're super happy and you go to like all the, what are the blogs, like TechCrunch and stuff, and you're all in the news. The moment that happens, the expectation is that your next round is going to be at least 2x. So what you just did is you just put a target on your back. That's literally what you just did. So I want to urge to be less fussed about the numbers at the early stage and just be more focused on just building the business and getting it done.
Yeah. I mean, just to comment on if it's low, you can only go up. If it's really high, 1 in 5 rounds right now is a down round, and so that's much harder. I mean, I think one of the points that you were making about this particular founder that sold for $250 million, I think what's really amazing about this story is that he stuck to his gut, or he or she stuck to his gut, or her. I think that's the hardest part about being a founder. There's so many hard things about being a founder, but that's one of the hardest things because people are always giving you advice, like us. Like,
there's 3 people on here. You're going to get 4 opinions by the end of this.
Why are we, why are you even listening to us? You should listen to your own voice because nobody knows your business, your history, your belief, your future, where you want to be in life. None of us know, right? And it's really easy, especially when you're taking advice or like listening to somebody who gave you money, to feel obligated to listen to them. And I don't know, especially in the last few years, and maybe because I'm a little bit jaded, because the last few years, this whole I had one investor say to me, Shirley, like, you're building a hotel. So I wasn't building a hotel, but that was the analogy. Like, you're building a hotel. Like, is it better to build it in 4 years, but slowly, but then in 4 years? Or do you want to, like, put all the money in and build it in 2 years and start operating? And I was like, well, I guess I want to build it in 2 years. And I think that was actually really, really bad advice. That was great advice in like a zero interest rate environment. And then we didn't realize, and this person should have realized because this person has been around a really long time, but I think in the last 15 years, he got really into the mode of just like build fast and so I felt really obligated to take his advice. And I think I really shouldn't have. And staying true to like what you believe in and like that's I want to say that's the hardest part because you're always as a founder like talking out of both sides of your mouth. You're like, I want to grow, but no, I have to have profitability. Like I want to focus on fundraising, but no, I got to focus on my product. Or you're always like on the extreme ends of things, and to know where your center is, I think that's one of the hardest things. So kudos to that founder. It's amazing.
So this profitability versus growth keeps coming up. It's creeping up in every answer that we're talking about right now. How are you advising those founders that have been through that entire roller coaster of a thing? Their targets, their goals, where they were allocating money when they had raised then was so much about growth. And now that everything else has happened and we're equalizing out, there's an entirely different narrative that's being screamed at them, not just from people on their cap table, everybody around them, the advice that mentors are giving. Like, whiplash is a real thing. It's the number one thing that we advise our startups when we start a program, right? Like, throughout this entire program, every single week, you're going to hear a different piece of information, know where you have to go. How are you managing those founders and helping them have the right mindset and helping them restructure those goals, because the ones that have raised have gone through that entire cycle, and if they're raising again to focus on profitability because of allocations that were done before, what's their next step?
Yeah, there's actually a fairly simple solution to this in the end. And I guess for the people that have kids, they would probably know is that when you tell your kids something, they ask you why, and then you explain to them and they ask you why again. And I feel this is what VCs and founders don't do enough with each other. So oftentimes we get this question about, I want to grow my business, but I also want to focus on profitability, and I can't do both. So my question is like, what are your assumptions? So one assumption that we oftentimes forget is when you put money into a business as an angel or as a VC, you have to talk about expectations. So it's our expectation that your business grows 15x a year, every single year for the rest of your life. It's fairly unlikely, but some people have it in their minds. Or is your expectation that within year 2, you're going to be super profitable and you don't need us anymore? Like when you have this conversation, when you are negotiating term sheet and talk about the future of your company, it's going to help you so much more, because we often set expectations after the fact. So I'll give you your money, you start running your business, and after year 1 I say, hey, I thought we were growing at 100%. And the founder says, no, I was like thinking like 20%-ish. What do you think of that? So that expectation never aligns. And if you align there, then you solve all the problems, because you can never have an issue around growth versus profitability if we align beforehand what our expectation is. So to give an example, when we invest in a seed business, typically my first conversation is not so much around profitability just yet, but we are talking about expectations. So for instance, how much capital do you need to grow this business in a certain market? How much capital do you need to grow the team to a stage where you feel comfortable you can grow this business 4 or 5x? What is your vision on where you want the company to be in the next 5 to 6 years? We can, like human beings, we can talk about it. We discussed this yesterday. Is that my favorite moment with a founder is literally somewhere early in the afternoon, early evening, outside of the office, pen and paper, and we talk about strategy for like 2-3 hours, and just sit down and talk about strategy and the different scenarios for the company, like all guards down. Those are the best conversations to have, because everything else is a bunch of BS. You can give me 1,000 spreadsheets and they're all not true. I can give you 500 forecasts and they're all not true. But when we sit next to each other and we're like, okay, this could potentially work. If we tweak this a little bit, this might work. Let's give it a try. Year 4, profitable, maybe. Let's see what we can do. Then you have a conversation between founder and VC, and then this entire conversation about I'm not growing enough, I want to be profitable. That all goes away.
That sounds simple enough. That's the end of the conversation, I guess. No, I'm kidding. Sorry, Shirley.
I was going to ask, do you worry about their execution?
Yeah, it's a very good question, by the way. So our best founders in our portfolio, they have one trait in common: they're amazing executors. They don't take advice, they take guidance, which to me is a little bit different. But they are amazing in executing. So as an example, if you tell a founder, hey, I have this like crazy idea, should we try X, Y, and Z? He or she will tell you, I tried it yesterday, I'm going to try it, and I'll tell you tomorrow how it works. And those are the best executors for me. So yeah, you are right. I'm definitely worried about execution. Yeah.
Did you have anything you wanted to add there? Because our model is run a little differently. We're helping them execute for 3 months.
Yeah, our model is that we force execution to the nth degree, right? So
we care about like team, and then because I would say we're much earlier than where you guys are coming in, no? Well, I'm going to open the floor to questions before I wrap up with a last question. Is there anybody that has a question that they would like to ask? If you have no question, it just means we've answered everything. You can't ask anybody any more questions about the VC landscape this year.
I'm curious, based on some of the ideas you're hearing, or at least at the pre-seed level, what are the things that you're interested in? What are the things that are the ideas that might attract investors at an earlier state or might be able to allow you to do more with the cash that you're given? General AI, is it AI in the intersection of something else? What are the things that are exciting you right now?
Just slap AI on your deck and we'll give you money.
Your URL has to end with .ai.
It sounds like a very easy answer, but we are looking for companies that are just solving real problems, just real life things. The downside of venture at this moment is 97% of the companies are copycats of something else. So it's very hard to distinguish one model from the other because they tend to look the same. So within that 97%, we look at, okay, how much impact is this business creating? So to give a few examples, food and food security is a big one for us in the coming future, because I think that is going to be more prevalent and more important. Logistics and supply chain, because that has shown over the past years how complex it gets with Black Swan events specifically. That's one. Healthcare is always a big one. So when we look at preventive healthcare, that's definitely a large one for us as well. Yesterday we were on a panel, and I specifically said I'm going to skip over fintech.
I was just about to say.
And that immediately kind of garners a reaction from the other folks, which was good. I'm saying this because we've invested in a ton of fintech companies, and they're all amazing. But we also realize that we think there is time for an era where we can really think outside of the box and build new ideas, new products, and solve new problems that we haven't even seen yet. So to give one quick example, when COVID kind of changed all of our lives like indefinitely, I felt there was a period where we should rethink solutions around healthcare. Like the easiest one is, okay, home education for kids. I get it, but there's so much more that we can do with all the information that we gathered over the past 3 years, that we're looking for these outliers in that space.
I'm wondering, I mean, both of your entities, Golden Gate and Techstars, have not been immune to the factors of the last 2 years. Can you talk about growing your footprint here in the region, and has the last couple of years caused you to maybe retrench from this market, rethink this market? What is your outlook for the Abu Dhabi cohorts, for example, or Golden Gate's activities in Saudi Arabia? Can you talk about just influence here specifically? Thank you.
I'll say this is my third trip to the region in the last 6 months. And last week, Maël Gave, who's the CEO of Techstars, was here. We're here constantly. We're super, super bullish on this market. There's a sense of optimism and builder mentality and like cut through the red tape like no other, I think, in this region. And so, our footprint, we're tripling down in this footprint. So you'll see more Lalitha, you'll see more Techstars.
I'll take a slightly different approach. Similar, we're bullish as well, but I want to add something to it. Venture is an extremely local business. So for a fund in the US to invest in a company in Indonesia is very, very tricky. And we know because we've invested in Indonesia over the past decade or so. Equally, it's very contradictory, it's also becoming more and more global. Because if I look at this cohort, for example, there's founders from literally everywhere that are using either Abu Dhabi as a hub or saying, hey, I want to from Abu Dhabi, I want to go into other markets. So we can't deny that we're going to see founders from Europe, US, from Asia that are looking to do stuff here. And we've seen something similar in Asia. Now, the other thing is even more interesting. In our last portfolio, we've had more global companies than ever before. So companies that come from Singapore that cater to a global market. My view is that if we fast forward 10 years, we're going to see global companies coming from this region. And that is what interests us.
And I think just to add on to that, the cohorts and the way programs are structured here and investments are structured here, you attract international talent because we're a hub. As much as, like it's called Hub 71, it's a hub for a region, and that is the tourism like aspect to it, the international aspect to it as well, right? You can connect to the entire world from here. It makes a ton of sense, and regulatorily, there's just so much of a plus point to set up here than anywhere else. The tourism board is not paying me yet, though, so they should think about getting on that.
My name is Anna. I run talent company for VC. So my question is about what do you see as a gap in the execution in terms of talent missing here, and how would you source this talent? Because obviously many people come from the European, US, Asian landscape to find a job here, but I think that still startups or businesses growing here still have some missing talent and competences, and where do you see the biggest gap?
I don't think I have a good view into that here. Yeah.
So not a gap, but let me talk about a concern that I have. Companies are getting way more complex from a technology standpoint, geographically, and just managing and running your business. Because of the influx of the number of AI companies, the first thing that I ask is, who are your main developers? Because I want to understand whether you are taking technology off the shelf, you have it in-house, or you're outsourcing. And how are you managing this? Because the differentiating factor for a company is not going to be, I'll take technology off the shelf, I'll do something funny, and then I have a company. Although companies do so, your differentiator is going to be, can I find that insane data analyst who sees something differently than 100 other data analysts? Or can I find that insanely engineer that has been working on AI for the past decades and is now coming to the forefront? So that's a big concern that I have, that we're seeing a lot of companies that have AI as part of their product roadmap, but don't necessarily have the talent in-house to be able to manage that. So that's a big concern for us.
So I just have one question in terms of exit strategy and how important that is. Obviously that's stage dependent, but if you could just touch a little bit upon how important that is for investment from your perspectives.
I mean, I'm sure you'll get the question if you're fundraising, and you should probably have a view. You should probably generally have 3 to 5 ideas of how you would exit, based on the different array of options out there available. But I would say that at least for us, we invest in pre-seed. So like our company's horizons are 8 to 10 years, right? So exit strategy is like so far down the road that if a founder's talking to me about exiting in like 3 to 5 years, I'm actually a little bit worried, right? Because you want to know that you're investing in somebody who is there for the right reasons and build because they believe they can make an impact. And I know that sounds like really cheesy, but like truly they want to create something that didn't exist before, and that to them is really important versus exiting. Now, exiting is the ultimate outcome everybody wants. At the end of the day, Techstars, we're an investor. We're looking for strong returns, period, nonstop. That said, we are also, like Lalitha said, team. We're betting on the founder. That's all really we have to bet on at this stage. And so we're looking for somebody, yes, they want to understand the exit strategy, but what they're really, really focused on right now is fixing the problem that they think needs to be fixed. So I know that's a little cop-out, but hopefully that's one view.
I got one small thing to add. Luckily, in conversations with other VCs when we are going into a round, we're now talking more about how are we underwriting a deal. And I think that is very important because for some of the early investors, it might be angels or super angels, their expectation is like a 3-4x. They're like, awesome, I'm going to reinvest it in like 3 other companies. I'm super happy. For us, less so. We want like 50, 100x on those deals. And that determines for us, but that's per deal, how we look at what a potential exit strategy or scenario would look like. So for some companies, who are thinking of, but they're mid-stage, I would say. We're thinking of, hey, an IPO is down the line for us. We really then want to understand, if that is the case, where do you want to IPO? And what does that trajectory look like? We have one company, and I can talk about it because they're public about it, in Singapore, that is in the pre-IPO stage. this is a conversation that's been going on for 2.5 years. I think they need about 1 or 2 more years before they're like fully prepped to list. So I tell founders it's a 4-year journey just to think about listing. So we like to talk about it, but yeah, at pre-seed, seed, or Series A, I'm like, nah, just focus on building your business. And then, but we do talk about how do we underwrite the deal and what are our expectations and our models in terms of outcome.
Can I ask you a question? I love that you used the word underwriting a deal. Did you use that? Did you guys think about using like that mindset like 4 or 5 years ago?
Nope. This is all very, very recent.
That's lessons learned.
Hi, my name is Nino. First of all, thank you very much for the guidance and not for the advice. And a couple of months ago, I had a quick discussion with one of my friends. He's an investor himself from Sweden. And his approach was really interesting, and I would like to know your thought about his approach in investing. Basically, he was telling me that every time he's investing in a company, he's making sure that the founder, he's also happy with the equity. Like, for example, if you have angel investors and VCs that are going to invest and they are ripping off 70-80% of your equity, you might lose as a founder in the pre-seed or seed phase stage, you might lose a lot of motivation, let's say, or interest, right? Is that true from your let's say, background, your experience? Do you think that founders aim to or tend to lose interest or motivation if they lose a lot of equity, or doesn't really matter, doesn't make any difference?
Well, every investor has a target, of where they're trying to get based on how much they're putting in, like their sort of threshold on how much equity they want to get. There's 2 schools of thought, right? One school of thought that's like, hey, 20% you founder of a really big number is still a really big number. And then there's I have 60% of a $250 million company. That's obviously actually better. Listen, I mean, everyone has a different philosophy on how much equity and ownership, but I do think it's really important because as an investor, the best type of company you want to invest in, which by the way is not we're pre-seed, so we're like helicopter parents at this point because we're pre-seed and we're an accelerator, so we're literally your helicopter parent. That's what founders buy into in our model. But for most investors, the best companies they invest into are the ones that you could just leave alone, right? And like Techstars is a different model. We have a lot of people because you physically need that many people to run an accelerator. Most VC firms don't have that many people. You could be a 5-10 people shop and be deploying hundreds of millions of dollars. So like ultimately, the best companies are the ones that you want to leave alone, and you can't leave them alone if they don't have skin in the game, like a lot of skin in the game. So,
you mentioned something about AI. I got something that right now is even, shall we say, even more buzzy, and that's quantum. Oh yes, and the issue becomes for somebody like me who is who's a subject matter expert, who's been doing this who's been in the, shall we say, national security space for a very long time, and I have a very unique idea, and it takes me a while sometimes to even get people to understand what the idea is about. And then when I do, they're like, so, okay, well, where's your deck? Here it is. And then they're like, okay, is this actually possible? Do you know the math? And I show them the math. They're like, well, actually, I don't have the background for this, so I need to get somebody else to look at it. So how do you get to that point when you have an idea that's maybe like 5 years ahead of time, that you know where the technology is going and you know you're able to do it, but right now, the thing that you can point to, for example, is a whole bunch of peer-reviewed articles that say, yes, this is technically possible, and yes, nobody's done this before. And that's why when they ask you, well, who else is doing this? Well, nobody. That's the whole point.
I got a real life example. This literally happened to us. We had we have now a company we invested in Singapore. Yeah, it's public. They're called Spectral. And so their focus is to use quantum communication to securitize communication between satellites and base stations. When they first showed up at our office for a pitch, and my partners are not going to admit it, but I know for a fact that no one understood whatever they were saying. So we were like, this sounds interesting, but dude, I have no idea what you mean. So what we did is we looked at okay, there's something that sounds really interesting, but I just don't know. So we looked at the co-investors, and we were fortunate enough to have very strong co-investors from this space that were on the cap table, and we were able to talk to them. So I think for those conversations, you will find people that have subject matter expertise, that you can find even smaller checks that you can find on your cap table, and they are going to be your ambassadors as well.
Hi, my name is Sama. I just want you to tell me your experience with EdTech and what's the future for EdTech.
Okay, yeah. So now, we have a few. One investment, recent one in the EdTech space. It's not easy. I'm just be very frank. I think it's different if you look at it from a B2B versus a B2C. If you are targeting schools, if you are targeting businesses, if you are targeting consumers. The company we invested in is both B2C and B2B. So the company teaches Singapore math, and they use it through schools, and they do it through. You can buy it online as well as a parent. I think they were very smart about marketing their product, because Singapore math is kind of globally renowned as a good way to teach math to kids, and they gamified the product. But we've seen a lot of companies in the tutoring space raise a lot of money, weren't able to make it. Companies having issues selling to schools because typically they have limited budgets, and for them, IT expenditure is expensive as it is. So I do feel that digitizing education makes sense on the longer term, but I think as a founder, you do need the expertise within this space, specifically if you are selling towards B2B.
Okay, we've got one more. Go ahead, Shirley, and then I'll ask.
Sorry, I was just add that, building in the tech space, to echo Michael's point, is really tough. It's just a market where the valuation is much lower because the market size is smaller. Selling into school is as hard as selling into the Department of Defense in the U.S. It's so difficult. And so I think it's a business where my advice would be let's figure out how you can get cash flow positive and just bootstrap it.
Kind of an obvious question, but hopefully a non-obvious answer from you guys. When have you ever been impressed around the answers to do with competition? So every now and again you come across super technical, deep tech companies and their first movers, which is great. But I imagine at seed stage, most decks you've probably seen before or seen something around that. And so you tend to think, okay, what makes you different? Founder market fit is one of those things. But I guess the high level question is, when have you been particularly convinced with a founder's answer when it comes to competition?
I'm really impressed when people have really deep and thoughtful dissections of their competitors, their product, their pricing, where they operate and why they're strong, and have a healthy humility and respect for their competitors' operations.
Yeah, the one thing I would summarize it as for the ones that have done their homework. For me, that's it. If there is a very clear understanding of direct competitors, indirect competitors, dissecting pricing, understanding where you are in terms of market sizing, where you want to get to. How hard it is to compete against them, how are you competing, right? So having that level of understanding and going through it sort of almost kind of at a line by line basis, that impresses me the most, because it's all about just you've done your homework as a founder, and the thing is that sometimes people forget is that you guys are educating us, not the other way around. So you are teaching us about your industry. If you can't tell me about your competitors, then who will, right? So, yeah.
Can I just add one thing to that? The most unimpressive thing, though, is when you say you have no competitors. Regardless of what space you're in, there is somebody or something that is going to be fulfilling that need, whether you realize it or not. And if you haven't done enough homework, and you're telling me that there's no competitors, might immediately, red flags in my head. So that's the most unimpressive version of that, the answer to that. Cool. We're at time, so we're going to wrap up here. Thank you both very much. Is there any parting thoughts you'd like to leave the audience with?
Yeah, I would say that this is a tough time to be building, and not that you don't know that already. I would say the difference between success and failure is just how much pain you can take. And it's interesting. This is why you see so many immigrants building really successful businesses, because you've overcome so many hardships. And we're really in that trough moment right now. Like, if you think you can't take any more pain, take a little bit more. Like, literally, it's just on the horizon. And 2025 will be here before you know it. So it's already May. Oh my God, it's already May. So I really think that there are, sort of like world events aside, that we're sort of at the kind of trough end of the cycle. World events aside.
Any parting thoughts?
Yeah, maybe a quick one, which is around like focus and decision making. I think every single day you get up and then you have a few choices in life, and that determines your entrepreneurship journey. The founders that I've seen with the best outcomes are hyper focused, and sometimes they sound like they're a-holes, but they aren't. They just know what they want. And the founders who know what they want and are able to communicate what they want and showcase that what they have in their mind is being executed, those are the best founders. But this means for you as a founder that every single day you have to disappoint people. Because people are asking you stuff every single day and you have to say no a lot of times. So it's always about, I don't want to disappoint my environment. I don't want to disappoint my community. I want to be there for others, and I want to help others, which is just all amazing, and you should never lose it. But the moment you have chosen to run your own company and become a founder, in your inner hearts of heart, you are an a-hole. Because you are the one person that is responsible for making this company successful. No one else. Not your neighbor, not your spouse, not your parents or your siblings, it's you. And you're responsible for your team. You're responsible for their salaries. You're responsible for making this $1 billion company. You're responsible for making me rich. So it is very important that you have that in you, because every single day you're going to be challenged. So focus is everything.
Okay, amazing. I think that's a wonderful note to end on. Thank you very much for your attention today, and we hope to see you at the next one. Take care, everybody. Thanks.